Michael Burry, who is famous for his accurate forecast of the financial crisis that occurred in 2008 and who was immortalized in The Big Short, has made a big bet against the stock market that is estimated to be worth $1.6 billion. This move has sparked discussions and speculations, and it has been the subject of much media attention. Burry, who is well known for his ability to spot anomalies and weaknesses in the financial markets, has recently been making bearish bets on the stock market in the United States. This exciting new phenomenon has caused tremors to spread throughout the financial investment sector. Today's video is all about Michael Burry's bets of $1.6 billion that the stock market will crash. Burry's strategic bets market watchers have taken notice of Michael Burry's most recent moves because of his track record of making correct predictions and his contrarian approach to investing. As part of his most recent endeavor, he has acquired put options with a total value of $886 million against Standard & Poor's 500 ETF shares and put options with a value of $739 million against Invesco QQQ Trust AGF shares. Because put options increase in value when stock prices fall, such bets are thought to be indicative of a defensive position. It is important to note that due to filing limits, the exact sums that are potentially at risk are not completely revealed. However, despite rare failures, such as his short position on Tesla in 2020, Burry's earlier achievements have brought major attention to his investing decisions. This is the case despite the fact that Burry occasionally takes short positions on companies. Michael Burry's strategic approach. Michael Burry has established his reputation on his ability to predict market downturns and oddities. His strategy is frequently of a contrarian character, and it involves looking for markets that appear to be out of sequence or overinflated. This strategy is frequently compared to the approach taken by a bear who goes against the generally accepted direction of market movements. Michael Burry's attention is currently fixated on the Standard & Poor's 500 index, often abbreviated as the Standard & Poor's 500. This particular index is a representation of the broader U.S. stock market and comprises the stocks of 500 of the largest publicly traded companies in the country. It serves as a significant benchmark for measuring the overall health and performance of the U.S. equities market. What has captured Burry's interest within the context of the Standard & Poor's 500's performance is a distinctive pattern that has emerged. This pattern involves a select group of stocks that have been responsible for driving the index's impressive upward trajectory. This subset of stocks is quite small in number and has effectively shouldered the bulk of the index's gains. Burry has chosen to refer to these influential equities as the Magnificent Seven. These specific companies have demonstrated exceptional growth and have been major contributors to the overall expansion of the stock market as reflected by the Standard & Poor's 500 index. The significance of Burry's observation lies in his recognition of the potential vulnerability of the market due to its reliance on this limited group of high-performing stocks. His decision to place a substantial bet against the stock market indicates his belief that the continued exceptional growth of these dominant stocks might not be sustainable over the long term. He has highlighted that there are only a few stocks within the Standard & Poor's 500 that have been responsible for the index's remarkable growth. These select equities, comprising only 7 companies, have garnered significant attention and are often referred to as the Magnificent Seven. Their exceptional performance has played a pivotal role in driving the overall expansion of the market. However, Burry's recent actions, specifically his substantial wager against the stock market, signal his skepticism about the sustainability of these few stocks' extraordinary growth trends. His strategic bet indicates that he doesn't believe these dominant stocks can maintain their exceptional growth trajectory indefinitely. In essence, Burry's move suggests that he anticipates a potential shift in the market dynamics that have been favoring these Magnificent Seven stocks. By placing such a substantial bet against the market, he is essentially betting on a decline in the performance of these high-flying equities. This could stem from concerns about overvaluation, changes in market sentiment, economic factors, or other variables that might impact the company's growth prospects. Burry's approach aligns with his history as a contrarian investor who seeks out opportunities where prevailing market trends may be unsustainable or overinflated. His keen observation of the concentration of gains within a few stocks and his proactive defensive position indicate that he believes a corrective market event might be on the horizon. While his predictions have been accurate in the past, it's essential to acknowledge that investing in the stock market carries inherent uncertainties, and outcomes can differ from expectations. Despite the fact that Burry's forecasts have, for the most part, been accurate, it is essential to keep in mind that even seasoned investors like him are still capable of making mistakes in their investment decisions. For example, his short position on Tesla in 2020 did not produce the results that he had hoped it would. However, the track record he has of recognizing market abnormalities and the proactive defensive maneuvers he has made provide credence to his most recent strategic positioning. Conducting an analysis of the broader market mood is crucial to understanding the context of Burry's actions. The Greed and Fear Index is a commonly used metric by market analysts to gauge prevailing market sentiment. This index has recently declined, moving from extreme greed to a neutral state over the past month. These shifts reflect changing perceptions of risk and reward, often responding to factors like interest rate changes and economic indicators. The broader market mood sets the backdrop for interpreting individual actions like those of Michael Burry, a prominent figure known for predicting the 2008 financial crisis and profiting from it. By assessing the market sentiment, investors can gain insights into the collective emotional state that influences market behavior. The Greed and Fear Index serves as an indicator of the dominant emotional tone in the market, whether it's excessive optimism or caution. The recent drop in the index signifies a move from heightened optimism to a more balanced sentiment. These swings in sentiment mirror changes in how investors perceive potential risks and rewards. These shifts are often triggered by various external factors, such as shifts in interest rates and economic indicators like GDP growth, unemployment rates, and inflation. In summary, understanding the broader market mood reflected by the Greed and Fear Index is essential for grasping the environment in which financial actions occur. It sheds light on investors' emotional states, their risk tolerance, and overall sentiment, all of which play a role in shaping market trends and individual decisions. While the observations made by Michael Burry hold a significant amount of weight, Warren Buffett, another prominent figure in the field of finance, provides another perspective. The fact that Buffett has such a successful track record and investment philosophy makes his opinions noteworthy. Buffett's Berkshire Hathaway had a considerable cash reserve during the early days of the COVID-19 pandemic, which served as a symbol of his cautious approach during times of uncertainty. Recent events point to a shift away from this cautious posture, as Berkshire Hathaway sold off assets in the third quarter with a total value of approximately $8 billion. This move may indicate a feeling that certain assets are overrated, which is a sentiment that Burry also holds, matching the opinions expressed by Burry. It can be difficult for the average investor to understand the ramifications of high-risk bets because of the stakes involved. It is crucial to learn from previous market downturns, such as the crisis that occurred in 2008, followed by the subsequent market rebound that occurred after the crisis. The most important thing to take away from this is the fact that although the market may be subject to huge shifts, maintaining a long-term perspective can frequently prove to be sensible. The specifics of a given investor's situation dictate the advice they should follow. Younger investors who have more time on their side are better able to weather the volatility of the market. However, in order to mitigate risk, investors of a certain age or those who have a significant number of stock holdings should exercise prudence and consider diversification. Michael Burry's wager against the stock market, which was $1.6 billion, has captured the attention of both investors and analysts. Burry's actions carry a substantial amount of weight given his track record of correct predictions and his reputation for taking unconventional approaches. However, even highly experienced professionals like him are capable of making errors in judgment at times. When considering his actions in the context of the broader market sentiment and contrasting those insights with those of other financial luminaries like Warren Buffett, one obtains a comprehensive view. The most important things for investors to do, regardless of their level of experience or level of average experience, are to keep themselves informed, settle on a sound long-term strategy, and be ready for the inevitable volatility of the financial markets. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.